That doesn't mean that the bar again is set lower or we can go back to 2025 because it's not. But it may mean that the market and especially the exchanges are starting to show a little bit more flexibility around the edges for companies that otherwise check the right boxes. Have you ever wondered what's really happening inside the emerging growth markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Emerging Growth Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman, Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most ambitious and committed entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a real, clear-time view of what's happening inside the emerging growth markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings, to reverse mergers, SPACs, secondary offerings, and the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
My name is Caroline, and welcome to Inside the Emerging Growth Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the emerging growth and microcap ecosystems and break them down in a live question and answer format for Joe to give you his take from the trenches. So before we get into today's topic, Joe, can you just give us an update on what you're seeing from the front lines of the emerging growth world?
Yeah, Caroline, I'd say the biggest thing I'm seeing right now is that the market is starting to crack open just a little bit. We're seeing a little bit more movement than we have seen in the first quarter of 2026. And part of that is really because I think the exchanges are finally starting to settle in under the new discretionary rules under 51013 that we've talked about in the past. And they're really trying to figure out how they're going to interpret and get these deals through the finish line in a little bit easier way. And I'll share something else with you. There's been some really big news coming out of the industry this week and last week, including what really looks like a major shakeup in the personnel department inside the Nasdaq listings group, which is something, everyone in this market should really be paying attention to.
Okay, so there are signs of a little more life in the market.
Yeah, that's right. I mean, there are definitely signs of a little bit more life, but remember, this is still a very selective market where not every company, just because they qualify, is going to get through the process. It's not going back to where it was in 2025 or even just, 6 months ago.
Joe, that was great color. And before we get into today's episode, just a reminder for everyone listening, on this show, we break down real questions coming out of the market from companies, boards, investment bankers, and other capital markets participants. At this point, we really have 2 types of episodes. One is our typical topical format, where we take a larger industry topic and get Joe's take from the trenches. The other is our quarterly market briefing format, where we step back and look at what the market and the data are actually telling us. So if you've got a question, send it to us at questions@lucbro.com. That's questions at LUCBRO.com, and maybe we will cover it on a future episode. So let's get into today's briefing. When you step back and look at Q2 so far, what is the first thing that the data is telling you?
Well, I think the biggest takeaway from quarter 2 is really that the market has moved in the right direction, but it certainly didn't normalize by any means. Remember, Q1 felt like a shock to the system because everything got a lot tighter and harder. Q2 felt like a little bit more of the market finding itself and maybe finding its footing. But people should be very careful not to confuse this increased movement with a full market recovery, because remember, the market is still much, much tighter than it was in 2024 and even the end of 2025.
All right, so let's start where most people are always starting, which is IPOs. What did Q2 tell you there?
Well, it told me that the IPO market is still very much alive and open, but really only for selective deals and in selective spots. So, year to date in 2026, we had 13 IPOs so far this year, raising about $425 million dollars or so. And the median offering size for those deals was somewhere around $20 million dollars or just under $20 million, dollars, Caroline. If you compare that to year to date 2025, there were about 76 emerging growth IPOs that raised almost $1.2 billion dollars with a median offering size of about $8 million. Dollars. So the market is still dramatically smaller, but the deals that are getting done are generally bigger and cleaner and at a higher quality level.
And what about Q2 2026 specifically compared to Q1?
Well, Q2 so far has been a little bit better than Q1 on the IPO side. Remember, Q1 had 6 IPOs, really 5, but our data team picked up a 6th one, which is a very unique and interesting deal that we don't have to get into now. But let's call it 6 IPOs if you're going by the technical data number. And so far in Q2, we've had 7. So that's progress, right? 7 is greater than 6. So that's great. It's improvement, but it's still nowhere near where we were if you compare that to Q2 2025, where there were almost 35 IPOs raising, just over $450 million. So I will tell you there is movement. We are seeing a lot more activity, but I certainly wouldn't call this a reopening of the markets just yet.
And what about the makeup of those IPOs? Did anything stand out to you there?
Yeah, I mean, a few things stood out in the data. I would say first, the median deal size really stayed elevated. Q2 2026 so far, we had a median deal size of about $16.5 million dollars versus 9.1 in Q2 of 2025. So again, we're talking about the concept of fewer deals, higher quality, larger numbers. And that matters because it tells you that the market is still favoring those better prepared deals.
But Joe, come on, there's another point in the IPO data that really stands out to me. I mean, Q2's median raise so far is still well above 2025, but it's lower than Q1. Is that telling us anything?
Yes, it's a great point, Caroline. I think it does tell us something. Remember, Q1's median deal size was about $20 million. Dollars. And Q2 so far, it's about $16.5 million. Dollars. So just to break that down again, Q1 had 6 deals with about $20 million dollars median deal size. Q2 had 7 deals with 16.5 million or so average or median deal size. That may not sound like a huge difference, but I do think it tells us that the exchanges are starting to get a little bit more comfortable for the right companies with the raises coming in below $20 million. Dollars. Remember, we were told earlier this year that deals that start with a 2 are going to get preference. So that really felt like a threshold for the market. But Q2 data is telling us that maybe the exchanges are backing off that a little bit for the right companies. Now, that doesn't mean that the bar again is set lower or we can go back to 2025 because it's not. But it may mean that the market and especially the exchanges are starting to show a little bit more flexibility around the edges for companies that otherwise check the right boxes.
And what else stood out?
Well, secondly, I think Nasdaq, clearly regained some momentum in Q2. Q2 so far, we've seen 6 Nasdaq deals compared to 1 New York Stock Exchange deal, and that's pretty notable, Caroline, because remember in Q1 there were 6 IPOs, really 5, but again, we're going to talk technical. Our data team is very, very thorough in this. There were 6 IPOs, 3 on Nasdaq, 3 on the New York Stock Exchange. Originally, we thought it was 5, but there was that one quirky deal. Never in recent memory have we seen the New York Stock Exchange equal or exceed NASDAQ when we're talking about emerging growth IPOs. So it was truly extraordinary in the first quarter. And of course, the second quarter is really, getting back to what we would consider normal, where NASDAQ's taking the lead.
So it sounds like Nasdaq's back in the lead and taking over again. Is that correct?
Yeah, absolutely. I mean, so far in Q2, just to be precise, and really year to date as well, NASDAQ has 9 IPOs in the emerging growth space compared to the New York Stock Exchange, which has four. Now, it's still a little bit better than years past because typically it's been about 85-15 in favor of Nasdaq or 90-10 in favor of Nasdaq. But these numbers where New York Stock Exchange is, creeping up a little bit in the data really reinforces something that I say all the time. Exchange choice is a real strategy in these deals. It shouldn't be a default choice.
Okay, so one of the biggest storylines from Q1 was that foreign private issuers basically disappeared. Did that change at all in Q2?
Yeah, I mean, it changed somewhat. Foreign private issuers definitely started to reappear in Q2. And that really matters because one of the clearest Q1 2026 themes that we saw was how absent the foreign private issuers were, at least from the IPO market and really from the broader market. So remember, year to date right now in 2026, there have been 9 domestic IPOs and 4 foreign IPOs. I mean, that's the complete opposite, by a country mile of what occurred in 2025. But in Q2 so far, we've had 4 domestic deals and 3 foreign deals in the IPO category. So again, you're seeing the foreign deals creep up a little bit in the data. Again, because I think Nasdaq is starting to get a little bit more comfortable with vetting the discretionary rules and hopefully starting to get these foreign private issuers through the door a little bit faster. Again, for the right companies, those that comply, they're being very, very careful. But it's good to see that the foreign private issuers are creeping up in the numbers and getting back in the mix again in a big way.
And would you say that's the whole story, or is there more to it?
No, listen, there's definitely more to it. Nothing is ever as it seems, especially when you're looking at the data. The more interesting point for me, though, is that the foreign private issuers seem to be making more of a comeback in the alternative pathways, not just the traditional IPOs. And that's a very important distinction that I think a lot of people overlook when they consider the emerging growth world. It really tells me that foreign private issuers still want access to the US public markets, but some of them may be finding the alternative structures more available to them given where the exchanges have evolved over the last 6 months.
We should probably say where they're coming from too, then, right?
Absolutely. I think, country of origin is a very, very important consideration, especially when you're looking at the data. Because remember, there's been a really bad rap for mainland Chinese or even Hong Kong companies at the end of 2025. So Q2, we saw a couple of these deals, and they were mainly from Canada, mainly from Japan. Year to date, we've seen companies from Canada, Japan, and Hong Kong. We still are working through the system when we're talking about mainland China companies or companies that are still solely based or solely their personnel are based in China or Hong Kong or really anywhere in Asia. So country and origin, structure, quality, all of that stuff really matters and goes into the mix under the new discretionary rules.
So let's move to direct listings because that seems to be one of the more interesting stories of 2026. What did you see there in the data?
So, Caroline, direct listings continue to be one of the most interesting stories in the market from my perspective. Year to date in 2026, we've had 12 direct listings. During that same period in 2025, meaning 6 months, we only saw 3. That's a very meaningful jump. And these are not tiny direct listings either. The average opening bid price year to date in 2026 has also been a lot higher than it was in 2025.
So should people read that as a sign of strength?
In part, yes, I think direct listings, matter because they may be slightly easier to clear with Nasdaq under the right circumstances and for the right companies. And clearly, they've become a very acceptable pathway both to the exchanges and to the issuers. But remember, they're not a cure-all for the listing process.
And what do you mean by that?
Well, I think direct listings remain a very important part of the process for the right company, especially as an alternative to the default choice of a traditional IPO. But the aftermarket for these direct listings really remains an issue in the marketplace. When a direct listing, gets onto an exchange, you're generally just registering existing shares. So you don't have the same horsepower that comes with an IPO on an exchange. And you certainly don't have underwriters providing, stabilizing transactions or watching the market. You really just have a bunch of existing shareholders getting registered. So even though many of the direct listings that we've seen have gotten listed and the numbers internally look a lot better, they really haven't shown the same type of opening day volatility or horsepower that IPOs tend to show. And a lot of them have trended down directly after listings.
Yeah, that's an important distinction. And what about the exchange mix there? Is Nasdaq dominating direct listings too?
Yeah, absolutely. Nasdaq appears to be the primary home for any emerging growth direct listings. New York Stock Exchange really doesn't seem to favor emerging growth direct listings in the same way. It views that structure as more of a larger cap product. So for this part of the market, it's really NASDAQ or bust.
Okay, so let's stay with the alternative pathways theme for a minute here, because uplists and crosslists have really been a major part of the 2026 story. I mean, how should we be thinking about that lane after Q2 so far?
Well, this is where the data gets more nuanced, I believe. Year to date 2026, uplist and crosslist are still ahead of 2025. We've had 11 alternative, uplistings or cross listings year to date compared to 7, I believe, this time in 2025. And of those 11 in 2026, 7 of them were organic, meaning they didn't have to raise money, and 4 of them involved capital raises, which together raised, about $100 million. So the uplist world is very much alive. But when you dig into that data and you think about it, 7 of them were organic, meaning they were strong enough to list without a capital raise. And to me, that's a really, really important data point.
But Q2 itself slowed down, is that right?
Yes, that is true. Q2 so far only had 2 uplists, which, was a little bit off what we were expecting for the second quarter. The first quarter had a lot of uplistings and cross listings, or a lot more, because remember, everyone was trying to figure out how to get to market or get to an exchange when the IPO world was sort of on pause for a good amount of that first quarter. So the second quarter was definitely slower. But when you compare that to 2025, that quarter only really had 5 uplistings. And again, 2 of them were, I think, financed and 3 were organic. So year to date, it's still strong, but Q2 clearly slowed for the uplisting, cross listing world.
And why does the fact that both of the Q2 deals were organic matter so much?
Because organic uplists are still one of the last real exceptions to getting to NASDAQ or the New York Stock Exchange without really being forced to raise $15 million in gross proceeds. And I know we've talked about that rule many times on different episodes, and I've talked about it many times just in general. So, assuming you qualify, Caroline, and have the proper trading support, you can take advantage of that exception. And it's a really, really important point because when we look at the market and we see 2 organic uplists and them taking advantage of this exception, those companies weren't forced to raise money. They weren't forced to dilute the company. If they didn't take advantage of this exception or they didn't have the right trading profile, they would have been forced, like every other company, to raise $15 million. And that might be a hard thing in this market and for certain investment bankers. So this exception in this pathway really matters.
So even though the pace slowed, the strategy is still very important.
Exactly. The fact that, both Q2 uplists were organic tells us something too. It really suggests that companies still want the senior exchange pathway, but pairing that path with a successful financing still remains hard to do in this market, I think. And the fact that 2 deals were able to do it without a financing is a very telling development.
So, Joe, if you had to compare Q2 to Q1 in one straightforward way, what would you say?
I would say that Q2 was definitely better than Q1 in 2026, but still very highly selective. You had IPOs improving modestly. You had the reemergence of foreign private issuers, which I think is a great thing. Direct listings remained very strong and a very important part of the alternative pathway process. And uplist really remained important as well. They pace just slowed for them in Q2 of 2026. So, look, the market gave us a lot of motion and a lot of forward progress, but it still didn't give us a broad based recovery.
And what do you think the data is really saying underneath all of this?
Well, I think it's saying a few things. First, the market is still a lot tighter than it was in 2025. That's for sure. I don't think anybody really could dispute that. Second, the exchanges are continuing to only approve deals where structure, quality, and credibility of the management and boards really line up with their expectations under the new discretionary rules. And maybe third, I would say alternative pathways are still doing a lot of the work in the market, even though the up listings were down. Direct listings were really up in a big way, and finally, maybe I would say it's still not enough to ask whether a company can get public. I will still say the better question now is what is the best pathway for the company in this market to get to a senior exchange, and do they belong on that senior exchange? And really what happens after they get there? Because that's the question the exchanges are asking. And that last part matters a whole lot in this market.
So, bottom line, Joe, what should companies, boards, and advisors take away from the Q2 update?
I think they should take away that Q2 was again forward progress and a little bit more movement, but certainly not a free pass like it was in maybe earlier years. And I would say that this is still a market where pathway selection, including some of the alternative pathways we've talked about, matter a great deal. And finally, maybe that the market didn't come really roaring back in Q2, but I do believe it's going to come back over the third and fourth quarter as the exchanges get more comfortable and start to open up these listing analysis and getting more comfortable with the process. So I'm hopeful that all of this is just setting up the third and fourth quarters for a little bit more movement and a lot more progress.
You've been listening to Inside the Emerging Growth Markets with Joseph Lucosky. For more insights from the trenches of the emerging growth markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@lucbro.com. That's questions@lucbro.com. Thank you for listening, and we look forward to next time.